Hello everyone, welcome back. Here is Ali Talabi and this is the second lesson from Module 10. In the previous lesson, we learned about the cost of capital, the weighted average cost of capital, and what does it mean? In this lesson, I'm going to talk about the components of cost of capital, and more specifically, we'll talk about the cost of debt and cost of a stock. And when we talk about the cost of stock or equity, we'll talk about the cost of common stock and the cost of preferred stock. And then we can put all the pieces together as we learned the previous lesson to calculate the weighted average cost of capital. Now, let's start the lesson. So when we talk about the cost of debt, usually we are referring to two major sources of debt financing. Either you are borrowing from the bank, which in this case you need to pay interest on the loan you receive from the bank. So there will be some interest payment, and we talk about this. It's kind of very straightforward because you know how much interest you are paying, you know the principal or your money you borrowed. So it shouldn't be that big a deal to calculate the cost of debt. And the cost of debt will be based on the interest rate you are paying. However, you might also finance from bonds. So you issued some bonds, so you borrowed from some investors, so you are paying some coupon. Actually, you are paying based on the coupon rate to bond holders. We already talked about this before. For the bond valuation, I encourage you to go back to bonds and bonds valuation if you have any question related to that. Now, if you are using the bond, the most relevant cost of financing will be the YTM or yield to maturity. Never use the coupon rate or coupon payment for the cost of debt when it comes to bond. Always use the YTM, which is more relevant to the cost of debt. Now, let's look at an example when it comes to a bond. As I mentioned, for the loan, it's not a big deal. Just use the interest rate as a cost of debt. But for the bond, it's a bit more complicated. You have to use the VITIM instead of the coupon payment. For example, the company is paying 8% coupon. So when the company is paying 8%, we assume the face value is $1,000. It means on annual basis, the company is paying $80. However, in the question is saying it is a semi-annual bond, which means every 6 months the company is paying actually $40. So this is not annual, this is the semi-annual bonds. So if you're talking about 8%, so we know 8% of the $1,000, which is the face value, becomes $80. However, since this is the semi-annual, you have to divide it by 2 to find the semi-annual payment. Every 6 months, the company is paying $40. So the expiry date on this bond is 5 years from now. So your N and the formula should be 5, and you're looking for the cost of capital. Remember again that we are going to calculate YTM when it comes to bond. As we discussed earlier, you need to use the financial calculator, or for sure you can use the Excel file as well when it comes to the YTM. I mentioned there are 5 major inputs or variables: PV, PMT, and I per year, and FV. That's a third line in your financial calculator. So we are using these inputs, and based on this, you will see that the cost of capital for this case becomes 9.27%, as you see here. You have to be careful here because when you are using your financial calculator, it gives you the interest rate for that 6 months, which is 4.6%, as you see here. However, as we discussed in module related to the bond, I mentioned that the YTM should be expressed on annual basis. How we can convert from 6 months rate to the full year rate? You need to multiply that by 2. So I'm just multiplying the rate I found from my calculator by 2 to find the YTM, which is 9.27%. So the cost of capital or the cost of debt in this case should be 9.27%, which is your YTM. You have to be careful again. If in the question it is asking to calculate the after-tax cost of debt, you have to multiply this 9.27% by 1 minus t. for example, let's assume your tax rate in this case is 30%. So if I'm asking to calculate the after-tax cost of debt, you have to multiply 9.27% by 70%. So in this case, your after-tax cost of debt becomes almost 6.5%. So to be exact, it's 6.49%. So your after-tax cost of debt, as you see, is less than the before-tax cost of debt. Which number you need to use in the cost of capital? For sure, we'll always go with the after-tax cost of debt when it comes to WACC, weighted average cost of capital. What about the stock? Now, if you're talking about the preferred stock, we learned that we can calculate the cost of preferred stock based on the expected return on the preferred stock. And what is the expected return on preferred stock? It's very simple. Since the assumption here is the preferred shares, you received the same amount of dividend forever. So just that's an example for the perpetuity. So if you just divide the dividend you receive for preferred shares by the stock price, this is actually the same as the dividend yield. You will find the cost of preferred stock. So the cost of preferred stock, or RP, is simply the dividend yield, which is the dividend you receive for the preferred shares divided by the stock price. So that's very simple. So if you have preferred stock in your capital structure, that's how you calculate the cost of preferred stock. In some cases, maybe you don't have any preferred stock in your capital structure, which means the weight of preferred stock should be 0. So you need to switch to common shares. Now, when it comes to common shares, how we calculate the cost of common shares. So let's talk about that portion. So when it comes to common equity or common shares, as I mentioned, there are several ways we can calculate the cost of common equity. One way is using the DDM. So we'll learn in Module 7 about the DDM, or dividend discount model, or also called Gordon formula. So if you rearrange the formula, you will be able to find the cost of common equity. The first portion is your dividend yield, and the second portion is capital gains yield, or simply the growth rate. So if I know my dividend 1 year from now, if I know my current stock price, and if I know the dividend growth rate, I can calculate the cost of equity. So if you need more information regarding DDM, I highly encourage you to go back to Module 7 and watch the formula, which I explained fully regarding the components. So by doing this, you can calculate the cost of common equity. Another approach is using CAPM. So what is CAPM? We haven't talked about CAPM yet, Capital Asset Pricing Model. In Module 13, I will talk about the Capital Asset Pricing Model, and I will show you how we actually can estimate the cost of equity. But for now, I'm just going to briefly explain how we can use the CAPM to find the cost of equity. So the argument here is, based on CAPM, the expected return has two major components. One is the risk-free rate, or risk-free rate of return, and the second portion is based on the risk you are taking. And how we measure the risk, it's based on the beta. What is the beta? Beta is showing the percentage of changes in the stock return given the changes in the market. So, you know, if you look at the stock market, for example, if you look at the S&P 500 to capture the market fluctuation, you see the market's going up and down, so it's changing. So that's the market. So you can call that independent variable. And also, you're looking at the specific stock, for example, Apple, Google, or any other stock. Also, the stock price for those companies are moving up or down. Now, how closely these two stocks are moving together, that's actually what beta is telling us. Beta helps us to understand how closely the stock and the market are moving together. If they're actually mimicking each other, in other words, if the stock is moving in the same direction, same magnitude, same significance as the market, we can say the beta is 1. So beta 1, it means that the stock is moving same direction, same amount as the market is moving. So that's why we're saying the beta for the market is 1. However, most of times the stock is more volatile than the market or less volatile than the market. So it's either greater than 1 or less than 1. So if that's the case, we can use beta to capture the stock risk, the risk of the stock and the volatility of the stock. Also, we are actually multiplying the beta by RM minus RF, which is called market risk premium. So market risk premium is showing the additional return on the market over the risk-free rate. And you are adjusting by beta, by multiplying by beta, and you are adding back to the risk-free rate. So this is showing the expected return for a specific stock given the volatility or the risk you are taking for the specific stock. Again, I will talk more in module 13, and I will show you step by step how to measure, calculate the beta using a kind of practical example, just getting the data from the market. I will show you how to do that. But for now, if you have the components, if you have the risk rate, if you have the beta, if you have the market return, you can also use this formula, the CAPM, to measure the cost of equity. So given the data, if you have the dividend or the growth rate, you will use the DDM, or if you have the beta or risk rate, you will use the CAPM. That's the second approach. That's the second common approach to calculate the cost of common equity. So that's it for today. So we learned about the components of the cost of capital. Thank you very much. So we learned how to calculate the cost of debt using for loan or for the bond, and also we learned how to calculate the cost of equity using the DDM and the CAPM. Now you know all the components, so you can go back to lesson 1 to put all the pieces together and to calculate the weighted average cost of capital. Here is Ali Talibi. Have a wonderful day. Talk to you soon and take care.